Good morning and welcome to the March 15th, 2023 meeting of the NYCERS investment meeting. Madam Chairwoman, Madam Executive Director, would you please call the roll?
Good morning, Chair, Mayor's Office.
Phil Dukes.
Comptroller's Office.
Allison Hirsch for Comptroller, Brad Lander, and John Dorset is here as well as an alternate.
Public Advocate's Office.
Elizabeth Guzman for Jemani Williams.
Borough President Manhattan. Borough President Brooklyn. Borough President Bronx.
Janet Peguero on behalf of Bronx Borough President Vanessa L. Gibson. Good morning, everyone.
Morning. Borough President Queens. Borough President Staten Island. International Brotherhood of Teamsters.
Ruben Torres, Lawrence Bosley, and Julie Colby for Teamsters Local 237 President Gregory Floyd.
Transport Workers Union.
Dave Katzman for TWU Local 100 President Richard Davis.
And District Council 37.
Ray Santander for Executive Director.
We have a quorum.
Okay, looking at the agenda.
Do you want to recognize the BERS?
Yes, Phil.
Yes, we'll
Oh,
recognize that. Yeah, go ahead.
I got you covered, Sandy.
Thank you, Melanie, and thank you, Phil. We're represented today by trustees Corinne Apollon, Allison Hirsch, John Dorset, and Russell Buckley. We're also represented by consultants and staff. We do not have a quorum. We will adjudicate this business at our executive committee meeting tomorrow. Thanks, Phil.
Sure. Okay, Ms. Winery, what is next on our agenda?
We will turn it over to John Dorset to walk us through the agenda.
Okay,
Great.
John.
So, good morning, everybody. Today we have a robust public session where we will be discussing the quarterly report as well as have a risk presentation, and then we'll go into executive session to discuss specific managers. So before we begin, I'd like to turn it over to Steve Meyer, the Chief Investment Officer, to walk us through the quarterly report and remind folks that if you have questions, please feel free to ask. And if you have questions that are not addressed today, but have questions between meetings, the staff of the Bureau of Asset Management is always available for trustees when there are questions about things going on in the market. So with that, Steve, turn it over to you.
Great, John. Thank you. And good morning, trustees. So I'm just going to give you a real brief update on fourth quarter performance and try to provide some context in terms of what's going on in the U.S. and global economy, as well as in the financial markets, which are just incredibly volatile the last week or so. And I'll talk about the reasons why. 2022 was a very challenging year for the U.S. economy, global economy, and financial markets. We had slow economic growth. Remember, the first and second quarter of 2022 were negative GDP growth. We had a peak in CPI inflation in June of last year at 9.1%. We had substantial declines in both stock prices and bond prices in tandem, which is unusual but not unprecedented. We had elevated geopolitical risks associated with Russia's invasion of the Ukraine. We have a changing relationship dynamic between the U.S. and China. And we had the most aggressive Fed rate hikes in over 40 years. Unfortunately, 2023 will likely be another very, very challenging year for both the U.S. and global economies, as well as the financial markets. And we're seeing many examples and evidence of that the last week. Conditions past and present, and then I'll try to provide some context and some outlook for 2023. On the next slide, inflation, both here and abroad, remains elevated. The Eurozone has come off the boil, approaching 8% CPI. Inflation's come down in the UK, but it's still over 10% or double digits. In the US, we've had inflation, as I mentioned, peaked CPI in June of last year. In February, it actually came in at just 6%, but still sticky and elevated, and certainly well above the Fed's 2% inflation target. On the next slide, just a pictorial representation of that. The white line on the far right-hand side, that is actually CPI, and unfortunately wasn't updated since the last print we just got yesterday. But CPI has come down in the States to just 6% from 6.4%. So it's directionally moving in the right way. It's just not moving as fast as many people had hoped. And we still have some element of stickiness around the core PCE deflator at over 4%. On the next slide, we're certainly seeing that stickiness. As I mentioned, we have, if you look at year over year, 6 and 3 month changes for core CPI in the States, it's clustered around 5%, which is a little bit of a headwind, a little bit of a challenge for the Federal Reserve. On the next slide, inflation around the world continues, as I suggested earlier, moving in the right direction. That red line is a reduction in the US CPI inflation rate. And you can see similarly in the Eurozone and the UK, things are moving in the right direction, although still very high relative to where the central banks would like them to be. On the next slide, look at US and European headline inflation. On the left-hand side, you can see the US headline inflation is really driven more by issues outside of food and energy. A very different story on the right in Europe. A lot of that has to do with the Russian invasion of Ukraine, elevated energy prices there, as well as impacting the cost of food. So different issues here and abroad, but still very high levels of inflation. Inflation drivers in the States, if you look at the next slide, there are 2 lines there. The decreasing green line actually represents goods inflation, which has come down very nicely and is getting closer to that 2% level. Versus on the far right-hand side, you can see that blue line has moved up pretty substantially. And that reflects the service sector inflation rate, which is still moving directly higher. On the next slide, consumer
Steve, can I ask a question?
Yeah, absolutely, Larry, please.
Yeah, the services line that's moving up what is it? Is that because of prices in various service sectors being gouged in some way, or they're paying more?
Yeah, it has more to do with the increase in costs associated with delivering those services, meaning wage price pressures. The economy, the U.S. labor market is incredibly strong. We have a 3.6% unemployment rate. Even though the participation rates moved up, we still have about a 5 million person gap, Larry, in terms of the number of open positions relative to candidates that can fill those positions. So right now it's that structural imbalance in our labor market that is, creating some upward lift in wages, which is not necessarily a bad thing for those individuals getting raises as long as it keeps up or surpasses inflation. But this is a challenge for the Fed.
Thank you.
Sure. On the next slide, just to look at expectations. Consumer expectations are for inflation to continue to move down over the next 12 months. Again, but the consumer expectations are still 3.9%. Based on the recent University of Michigan survey. Again, well above the Fed's 2% target. On the next slide, as I mentioned, we had just an incredible, we have a strong labor market. We had an incredible January non-farm payrolls report, which indicated over 517,000 jobs were created in our economy. It pushed the unemployment rate down to 3.4%, which was a 53-year low. We've since gotten the last report last Friday for February non-farm payrolls, and it was above expectations. I think consensus estimate was looking for the economy to create 250,000 jobs. It came in above that at 311,000 jobs. Slight downward revision of I think 13,000 jobs to the January 517,000 number. And unemployment actually moved up a little bit from 3.4 to 3.6%. Again, that had more to do with an increase in the participation rate in our labor markets in the States, which is a good thing. On the next slide, just a look at unemployment. You can see on the upper part of that, that's the participation rate that I spoke of. It is actually moving. It's still significantly below where it was pre-pandemic, but again, it's making some progress, moving up to where it had been, and we had a little bit of forward and positive progress there in February as well. And on the far right-hand side, you can see unemployment, again, in January, 3.4%. And that's actually come up to 3.6% with the last print on Friday. Next slide, just a look at the composition of the January report. A lot of the sector hiring is in service sectors, and you can see that on the far right-hand side. We had healthcare and social assistance services, professional and business services, and leisure and hospitality services, really driving the increase in employment in our economy right now. As I mentioned earlier in the next slide, we do still have that structural gap where there is significantly more demand for workers than there are candidates. And this certainly reflects that in terms of job openings versus the number of people that are unemployed. It still is about a 5 million person or a worker gap there. On the next slide, a look at economic growth. We did have downward revisions to our early estimates for fourth quarter GDP from 2.9% to 2.7%, still relatively strong. We see that China has also reopened. They've reduced their COVID protocols. The market had expected them to forecast a GDP estimated growth for this year of over 6%. But the Chinese government came in and they're looking for just 5%. They think there's still going to be some residual headwinds associated with coming out of the pandemic. It's positive for global economy, will probably help the US and European economies grow, as China had been previously an engine for global growth, but not to the extent. A lot of their activities right now are focused more on developing the domestic economy versus their export sector. On the next slide, just a look at economic growth and where it's been. You can see obviously that tremendous tumultuous period of the pandemic and the volatility afterwards, the downward shift and then the recovery. But it's starting to normalize on the far right-hand side as we were ending 2022. On the next slide, consumer sentiment has been all over the place. This is a chart that actually looks at the prospective home buyers and the traffic in homes. You can see that it really plummeted with the increase in interest rates in 2022. In January, we had a tremendous rally in interest rates. U.S. 10-year yields were down quite substantially, and 30-year mortgage rates, if you are to go to the bank and get a mortgage, were over 7% and then rallied down to the low sixes. So that turning point on the bottom right-hand side, I think, is probably a moot point at this stage, given the fact that we've retraced a lot of that yield reduction, and today it's just incredibly volatile. So more to come on that. Investment sentiment, if you look on the next slide, this is the most anticipated recession of all time. You can see that these are professional forecasters on the far right-hand side. I don't know if you can see it, but there's about a 45% estimate of a recession in the coming 12 months. I suspect it probably might be a little higher than that, given some of the developments we've recently seen in the marketplace and the economy. On the next slide, a look at the probability of recessions being priced in. Let's start on the far bottom part of the slide. That's China. And as they come out of COVID, there's a very low level of risk associated with a recession there, relative to where we are in the US, the UK, and the Eurozone, the further up on the chart. So there is a significant expectation of some slowdown. I don't think that a recession is necessarily imminent. It's probably more than a 50% likelihood that we will see some economic slowdown that will equate to a recession, although it's not necessarily a foregone conclusion. And we may see a non-recessionary soft landing as well. But I think, again, as there's more disruptions in the financial markets, more volatility, I think that will probably increase the likelihood of a more dramatic economic slowdown. On the next slide, thanks. A look at where we are with global interest rates. Again, getting back to concerns about a US 1970 style inflation. We've seen rates move substantially higher. We have had the Fed raise rates now since March of last year. In the last tightening cycle, remember that they only tightened 25 basis points. They have another two-day meeting next Tuesday and Wednesday. The market's still pricing in about an even likelihood of a just a 25 basis point rate hike. But again, given the volatility, given the disruption in the financial markets, particularly the regional and now some of the money center banks, the likelihood of the Fed hiking into a distressed marketplace really comes into question. So a lot of uncertainty there. We also have an ECB meeting tomorrow and a potential rate hike as well. Also, next week on Wednesday, at the conclusion of the Fed's meeting, we get a new summary of economic projections, that dot plot, and we'll get a little more insight into what the Fed's thinking about the terminal rate of Fed funds and how much more they have to do, again, waiting what's going on in the markets today. On the next slide, just that representation of where we are. Far right-hand side, you can see that we've had some massive increases in rates coming off the near zero bound in March of last year. We're now at 450 to 475 range. And again, there's a likelihood that continues to move higher. The question is the timing. And will the Fed actually raise rates next week? On the next slide, just a reminder, this has been the most aggressive Fed tightening cycle in over 40 years. That red line on the middle to upper left-hand side of the chart is actually evidence of how quickly the Fed's raised rates from, again, that near zero bound to 4.5%. On the next slide, a look at financial conditions. Financial conditions have eased slightly. That white line actually is US financial conditions, and the green is actually financial conditions in the Eurozone. And obviously, financial conditions are much tighter in the Eurozone for a number of reasons, and that will be certainly a headwind for growth. But given the levels of elevated inflation there, the ECB and the Bank of England, for that matter, still have a lot of work to do. On the next slide, rising bond yields. We've seen bonds rally in January only to give it all back, plus some in February, and they've been incredibly volatile in the month of March, month to date. Today, we see a near 50 basis point move in two-year yields alone. A week ago, we had yields in the two-year US Treasuries at over 5%. It's around 375 this morning. So that's just an incredible move in yields in a very short period of time. So evidence of increased volatility, a lot of uncertainty, and a lot of stress in the financial markets. And one final point on this, actually, that's fine, Wilfredo, I think we're good on the next slide. You can see the yield curve more recently at the end of the year in red on the far left-hand side. You can see that it's inverted, meaning that short rates are actually higher than longer maturity rates. And that's typically not the case. Usually you receive some sort of maturity or maturity premium for buying longer obligations. And it's being impacted now based on monetary policy, obviously with the Fed hiking short-term rates so quickly. It also evidences expectation that the market believes that there will be a recession, a slowdown that will be followed quickly by additional rate cuts afterwards. The yield curve had been inverted almost 110 basis points following Powell's remarks last week. That is now, I have no idea where it is now, but as of about an hour ago, it was 45 basis points. So that's, again, a very dramatic move in that two-year Treasury to 10-year Treasury yield spread. On the next slide, this is already dated as soon as it went to press, but on the white line up top actually reflects the two-year yields. At the time this was printed, it was about 480. Last week, it was over 5%. As I mentioned earlier, I had a note this morning at 7 when I came in. It was at 390. It's in the 370s now. So an incredible flight to quality and a reduction in expectations for the imminence of a rate hike on the part of the Fed. And the 10-year yields are in green. They were at 348. They're probably well below that as well this morning. Credit spreads on the next slide. You can see, I don't know if you can see it on the far right-hand side. Those are high yield spreads in orange. Typically, they're compelling at over 500 basis points. This slide has them at 397. They're around 450 today, and probably credit spread moving higher given the level of uncertainty in the marketplace. The white line on the bottom is our credit spreads for investment grade corporate bonds. This slide, I don't know if you can see it, but it's at 120 basis points. It's just under 160 basis points today. Again, that has more to do with bank spreads widening. The next slide. It's the dollar had been incredibly strong last year. That strength has diminished somewhat, and even diminished somewhat further given the recent volatility over the last, say, 10 business days in the marketplace. The next slide is evidence of that. Where when this was printed, we saw the euro the British pound, sterling, and the Japanese yen, all strengthening relative to the dollar compared to where they were, say, in the third and fourth quarter of last year. And that strengthening on the part of foreign currencies, the weakening of the US dollar has continued. On the next slide, just a reminder that 2022 was a very tough year for stock and bond investors. We had the S&P 500 off more than 18%, Russell 3000 off even more than that. We had that unusual circumstance where bonds also moved down in price in tandem with equities from a very, very low starting point of yields. That's not unprecedented, but it is unusual. Typically, you have the benefits of having bond positions move in the other direction with equities as an offset or balance for the portfolio about 87 or 88% of the time. That wasn't the case in 2022. So the last comment on this slide, as you can see, the lower right-hand side talks about the bond route of 22 ending the golden age for fixed income. That really talks about that 40-year secular decline that we experienced in interest rates since the late 1980s. I think that probably is that trend had bottomed out and is probably behind us. It doesn't mean the fixed income doesn't have an important place in your portfolio, particularly as yields have been higher and you're being rewarded more for the risk than you had been at those extreme low levels of yields. On the next slide, this was really a representation that we pulled together in the early part of March that looked at 1-year sovereign spreads, including the U.S. Treasury 10-year yields. These are all 10-year sovereign spreads. On the far right-hand side, you can see that 1-year change. Those are the increases in yield spreads. So 211 basis points or 2.11% increase in just the yield on U.S. Treasury 10 years. That was across the board, across all manner of economy in 2022 or the last year through the early part of March. Market volatility on the next slide has been really quite incredible. As measured, equity volatility is measured by VIX on the left-hand side. Right now, it's still under 30, which is surprising to me. Usually, when it's above 30, it indicates risk off, meaning there's more selling pressure. Below 20, again, below that green bar, it tends to be more of a risk-on mentality where people are buying risk. We're at 28, probably going slightly north of that today. I think the more interesting story is on the right-hand side, which is the MOVE index, which indicates implied treasury market yield volatility, which is still well above where it has been on average for the last 30 years and has actually moved up over the last couple of days. On the next slide, just a quick comparison. On the right, you can see that there's a difference between the level of volatility we're seeing in equities relative to history going back to just 2019. But you can see here again, clear evidence that there's more volatility, more price volatility in bonds right now than there is in equities. The next slide, just to look at returns. Really, this is taking us through 2022. On the left-hand side, you can see that we had a significant sell-off in US, the Russell 3000, the MSCI EFA, ex-US, and the MSCI emerging markets in red at the bottom. They did make a turning point. They did have a substantial rally in the fourth quarter, which I'll talk about in a moment. And most of the markets had moved up pretty nicely early part of this year, but volatility has pushed those returns back down closer to, well, single digits in the case of Europe and pushing them even closer to flat to negative in the States. And same thing with the Barclays Ag on the right-hand side. You can see that there's an incredible amount of downward pressure on returns in 2022. Came back a little bit in the fourth quarter, but again, it's just incredibly volatile the last couple of days. Let's say maybe move two slides ahead, Wilfredo. And the question that consistently is asked is, why is the recession always 6 months away? We're hearing that the Fed's been raising rates for over a year. It's very well represented in the media that the Fed rate hikes typically operate with a variable and long delay. We've only been at this for a year, and we do have a very continued strong consumer and a very strong labor market as well. That is a headwind for the Fed in terms of slowing the economy, and that's why they continue to raise rates into 2023. Two more slides, and I'll get into performance. On the next slide, Actually, one back, yep. This is just, it overlays the current CPI that we've seen since 2014 relative to where it had been in the 1960s, 70s, and 80s. The takeaway from this slide is once the Fed starts raising rates, traditionally, at least looking back to the 1980s, it would take 2 years for them to bring inflation back down to the level that was acceptable. And that just leads me to believe that we would see the Fed get to a level of terminal rates that are high enough where they think they're suppressing inflation, but then to stay there for a longer period than we would traditionally expect to see, or what the market had priced in. On the next slide, this is the last slide from an economic update standpoint. This is why everyone's so interested when the Fed stops raising rates, because traditionally, once they stop, 12 months later, the S&P 500 is up 15% on average. And that's why that's just so important to see when they get to their level of stopping rate hikes, to see how that plays out in the economy. And if it creates a slowdown that necessitates a decline in rates, you'll see the S&P 500 rally traditionally. Now, more importantly, let's get to performance for NYCERS. Let's start on slide 38. You can see that obviously 2022 was a tough year. And you can see the one-year numbers all in red in the middle. I'd say more to this presentation, however, to the side left of that, we had a very nice rally in the fourth quarter of public market returns. The Russell 3000 up top was up 7.18%. The international developed ex-US market was up over 16%. And emerging market equities were up 9%. Duration was still challenging for very, very long duration strategies in the States, but we did have a pretty significant tightening of credit spreads, which increased the yields and the returns for corporate investment grade, as well as high yield at the bottom of the chart. On the next slide, quick look at NYCERS net public market returns. And let's focus on the 3 months. You can see that you had positive returns across all your asset classes with the addition of cash. We don't have a formal allocation of cash, but we always maintain some level of cash to meet benefit payments as well as capital calls. So that's good news and reflective of that, coming off the low points of the third quarter of 2022 and rallying into the fourth quarter. Still a lot of volatility, as I've said earlier. I think also it's important to reflect on the far right-hand side of that slide, the 5-year returns. And again, as long-term investors, you need to try to think I know it's hard to ignore what's going on in the world when the world seems like it's melting down a little bit. And we had a very tough 2022. Focus on the long-term returns, and that should be our objective and our positioning. On the next slide, a look at the NYCERS net private market returns. Here you can see in the one-year sector that despite the fact that we've had a lot of volatility in market selling off in the public market space, we had pretty decent returns and all positive returns over a one-year period in our private assets, from private equity all the way through opportunistic fixed income, which tends to be more floating rate obligations, but with below investment grade credit borrowers. So as credit spreads have widened and in that space, it's kind of constrained the returns there, but a great outcome. Looking further out in 5 and 10 years, it's been incredibly beneficial to be in private markets. And you can see that as evidenced by the 5-year returns. Private equity on average up 15.9%, 10% for core real estate, 11% for non-core real estate, over 11.6% for infrastructure. And again, opportunistic fixed income coming in at just under 7%. Say more importantly, however, is the NYCERS total plan returns on the lower part of that slide. And looking at the quarter's outcome in 3 months, you actually outperformed your policy benchmark by over 50 basis points. I know that if you eyeball this, it looks like 60 basis points. It rounds down to 50. I think it was 52 or 54. But that's a great outcome, notwithstanding the challenging year it's been. I'd say more importantly, if you look at the far right of that lower portion of the slide, and I don't know if you can see it, I can't see it on my slide, but it has NYCERS total plan returns, including private assets, up 5.5% over 5 years on average, relative to your policy benchmark returns of 5.1%. So 40 basis points in outperformance there.
Steve, just a quick question. Did the denominator effect have any positive or negative effect on our portfolio?
The denominator effect, it pushed the allocation to private equity up above the target level by about 1.5%.
Mhm.
And I don't know if that's a positive or negative, because again, those are long-term investments that play out over time. It did impact it, but not to the extent we've seen away from us. I know that there's been some, as a result of that extreme level of denominator impact, Larry, you did see some forced selling away from us. We also were constrained by the basket clause legislation, so our allocations tend to be slightly lower than average, certainly lower than endowments. There are some public pension plans out there, like down in Texas, teachers, for example, that have over a 54% allocation of private assets, versus ours is in the 20s. And again, some of that constraint has been removed, or at least lessened a little bit, by the change in legislation around the basket clause. But again, the trustees will have the decision later this year to decide whether they want to change the strategic asset allocation to maybe have more exposure to private assets, or potentially a higher allocation to non-US equities. So that's all in the works. Those are your decisions. We're working with the general consultants, kind of put a plan in place so we can present options to the trustees in the coming months.
Thank you.
Sure. On the next slide, just to look at the representation, as I said, we've had about 50 basis points, a little over 50 basis points in our performance. That was mostly due to investment manager selection on the far right-hand side, that selection effect. That's really the implementation of the asset allocation around active strategies, in particular in the private market sector. On the next slide, a look at NYCERS public market excess returns, again in basis points. So excess returns for your equities relative to the Russell 3000 benchmark for the fourth quarter of last year generated another 122 basis points of outperformance relative to, again, that index. And you can see down the line, it was kind of a mixed bag. Emerging markets also outperformed by 115 basis points. Global developed ex-US underperformed by 19. We had significant outperformance in convertible bonds at over 322 basis points. And if you look across that line, 322, and in 1 year, 837 basis points of outperformance, but significant underperformance in the 3 and 5 years. That's because of our allocation to and our management of convertible bonds tends to be less risky and more conservative. So we underperform when the market had a significant rally the last few years, but outperformed in an incredibly challenging market in 2022. But lastly, and certainly not least importantly, the total NYCERS relative to its policy benchmark on the bottom bottom side of the slide, you can see that you actually outperformed for the quarter your policy benchmark by 54 basis points. And over the last 5-year period, you've outperformed an average of over 38 basis points. And again, that includes public and private assets. Next slide, I'll look at your private market excess returns and basis points. And in the 1-year sector, you can see that the private equity allocations in your portfolio relative to the Russell 3000 benchmark, which again was off about 20%, outperformed by over 2,000 basis points or over 20%. So a significant outperformance for private equity relative to public equity. Now I'd be remiss if I didn't mention that there's a different convention. There's a little bit of a lag in terms of market to market and valuing those assets. The private assets tend to be valued a little bit more conservatively, so they generally tend to be less volatile. But my expectation is you'll see some level of negative marks in those positions over the coming quarters. Not nearly as dramatic as I think we saw in the public markets. Looking further, non-core real estate was the one outlier in the entire screen here, generating a negative 720 basis points in returns for the 1-year period in 2022. That had more to do with the fact that the non-core, the opportunistic, and the value-added real estate strategies tend to be higher risk, and in a risk-off environment, they tend to underperform. So other than that, very strong performance across the board. And again, I think if you look at the 5 and 10 year results, or the since inception results, they're incredibly strong and really quite excellent. So good decisions on the part of the trustees to engage in those assets over time. On the next slide, just to look at some of the activities, or the activity, I should say, in the fourth quarter, we raised a little over $1 billion in cash to meet distributions, benefit payments, as well as capital calls. We also, on the right-hand side, you can see U.S. equity. There was a global allocation increase of 150,000, and that was actually to fund the Pictet Climate Solutions portfolio. And the rest of that, you can see on the left-hand side, Robert Fang was actually selling credit at 860 million, really to rebalance the portfolio and buy some of the more interest rate sectors, mortgages, as well as long and short-term treasuries, to really rebalance the portfolio. Typically, when we raise cash to meet capital calls or meet benefit payments, we tend to sell treasuries versus credit. And this is just really a year in rebalancing to put things back in line. On the next slide, and this is my final slide for this section, just a look at over and underweights, and we were all well within the target ranges for your strategies consistently over time. And with that, I'll open up to questions. I know I've tried to be quick. There's a lot going on. I probably threw too much jargon at you, so I'm here to answer any questions you can have. You may have. Maybe just another further quick update in terms of the exposure to the Silicon Valley Bank or the Signature Bank. There were very, very minimal positions across the board. For NYCERS, it was less than 0.5 of 1 percentage point in aggregate exposure to regional banks, and not those two in particular. The exposure to them were de minimis, if any. And given some of your active strategy, you actually had a negative active risk to regional banks, meaning that your external managers tend to be short regional banks. So hopefully that'll play out as a positive return impact on your portfolio over time. Sorry, Russell, I see you have a question.
Yeah, thanks, Steve. And thanks for that BAMogram earlier in the week on Silicon Valley Bank and Signature. It's just good. I know I get questions about these types of things from members that know that I sit on these boards. So it's good to have your perspective in hand. I have some continued curiosity about our private market marks, but my question today is actually about fixed income and our bond portfolio performance. If we want to go back a couple slides, I mean, it's the overall public market return slide for Q4 and then through the 5 years. Not excess returns, overall returns. Thank you. I'll tell you something that you already know, which is obviously that the US government long duration, seeing a lot of red there, obviously, as interest rates rise, bond prices are dropping, just fundamental market dynamics of price depreciation. I guess my question is about it's about overall strategy in fixed income, but it's also about the city's accounting policies a little bit. So obviously the city can't have a bank run, so to speak, on the pensions, but we do still have to manage cash appropriately. Reading a little bit about the bank term funding program the Fed set up to absorb these mark-to-market accounting and book losses on long-dated treasuries for any bank that wants it. It gets me thinking about whether or not we can just hold our bond portfolios to maturity, just kind of clip coupons and mark their book value to cost or par. You know, in a world where the 10-year T-note is yielding 3.5 or 4% rather than 1%, our target return is 7%. Like, is there a world where we're allowed to mark these bond securities as not available for sale, as held to maturity, to potentially avoid some of the red that we see in price depreciation in our fixed income portfolio?
Well, Russ, I think so not that I'm aware of, certainly not in the public pension plan space, and you've already felt the pain associated with that increase in yield and the depression in treasury prices. You see that in performance on a quarterly basis. So that's already priced into the portfolio. The
Yeah,
other thing that manages, there are elements, so you're not just long treasuries. Sometimes you're long short treasuries as well, which tend to recycle. So as things mature in the portfolio, your outside managers are actively reinvesting at the higher yields, which is a positive. I actually look at the backup in yields in 2022 as being painful, but I don't necessarily think it's a bad thing for pension plan investors or NYCERS for that matter, because it does give an opportunity to reinvest at higher yields that are more rewarding for and beneficial for the plans over time. In terms of generating some level of income, it also provides a better level of buffer when you have 10-year treasury yields in the low 1% relative to 4 or 3.5. There's not that much of a buffer there, and it's substantially higher now. I think also just you see the evidence of that situation where the treasury portfolio or treasury holdings actually provide balance for the portfolio. Like we've had an incredible rally in treasuries over the last couple of days, mostly as due to flight to quality. Some also shifting expectations of where we think the Fed's going to go in terms of rates and what the impact will be on Fed hiking policy given the volatility. But that flight to quality has been beneficial for the portfolio as well.
yeah, no, that all makes sense to me. I guess that being said, obviously the fixed income is supposed to serve as ballast in the portfolio, but we just see so much red in the performance, right? And that is the price depreciation. That is because our portfolio has been constructed over time, pretty long duration, and interest rates have risen. I guess we're marking these to market. That's what the red would indicate to me. So I guess my question is whether or not there's any world where we can whether we're even allowed to hold these to maturity, or if we have to always mark our fixed income portfolio to market, and then whether that's a question of overall strategy about how we approach fixed income and its role in our portfolio.
Yeah, we're very different than say a bank that owns these as high quality liquid assets, which gives them the ability to treat the assets differently from an accounting standpoint or from an insurance company's perspective.
Sure.
So we really don't have that luxury. We mark to market our positions, irrespective of whether they're public or private markets, consistently. A little bit with a delay with privates, but the public is that market reprices. We look at this every day. I believe, Russell, if it's okay, we also have Robert Fang. He's our asset class head for fixed income, and I know he's on the line. Robert, do you want to comment on just what you're seeing and your thoughts on fixed income as a diversifier for the portfolio?
Yes, sure. Russell, can you hear me?
Yes.
Okay, great. Yeah, we've seen enormous volatility in the markets, as Steve was saying. These portfolios are active portfolios, but they are measured pretty closely to the benchmark in terms of their volatility and their tracking error. So they're not, we don't have a stagnant portfolio in which we just buy and hold. If we were managing our own assets, then that's something we can consider. But they're looking at this portfolio, and this is something where we don't advise them on anything because this is their portfolio performance. They get judged by that in terms of us hiring them and us, deciding ultimately, to recommend a termination to the boards. So the performance is based on, how they see the world. And as an active portfolio, you kind of want to make changes to it to try to capture things in the market that we see. Any kind of, there's issues in the market that you're seeing right now. And they're trying to capture, the best way to perform in that market, the alpha. So in general, it's been really, really volatile these last 3 days. We've seen yields go up, go down.
Yeah.
And from our perspective, we have a long-term asset allocation, and basically we're just, we're waiting to see because someone's wrong here. They're trying to cover it. So, that's basically what overall we're thinking right now. Just be close to the benchmark when we don't have as much conviction. This is something that's different from last year. Yields are right now at 350. So last year at the end of 2021, 10-year yields were at 70 basis points.
Yeah.
So they have a long way to go up, but not a long way to go down.
Sure.
So that gives us more conviction in terms of what we're thinking about. But right now we're very close to the benchmark. So
that makes sense. And the actively managed piece of that versus managing in-house, makes a lot of sense to me as well, as far as a portfolio strategy perspective.
Yeah, there's a lot
Not
of
going to
benefits.
ask our managers to hold bonds for us for 10 years.
Right, exactly. I mean, there's a lot of benefits to both sides, so.
Okay, thank you for
We-
that answer, Robert. I appreciate
No
it.
problem.
We
Thank
should
you.
also mention, though, that we do manage cash in-house. You have a zero allocation of cash. We always have some element of cash that we maintain, again, to meet distributions, payments, as well as capital calls. We've actually really tightened things down. We hired a new gentleman who was worked at 11 years as an analyst at Moody's, who is actually helping us re-underwrite our credit policy and positioning. But we have tightened things down. We're only buying money center bank paper. We've reduced or eliminated any potential exposure we had to any of the regional banks. And we're really focusing mostly on short-term US Treasury bills. There are structures out there right now that will yield another 20 or 25 basis points above what we're buying. We don't care. Now's not a time to be cavalier around risk. We're being defensive and conservative. Again, particularly, well, given the nature of the cash holding and what it's for, it's very, very short term, and it's to meet, again, benefit payments and capital calls, not to strategically position a portfolio.
Yeah, no, those details in the BAMOgram at the beginning of this week were definitely informative and helpful. So thank you. And thank you to NYCERS trustees for indulging me. Appreciate it.
So if there's no further questions for Steve, we want to note that we have the head of risk for the Bureau of Asset Management, Ed Berman, on to do a quick update on risk. So we'll turn it over to Ed and just remind folks if there are questions with his team between meetings. So Ed, we'll turn it over.
Thank you, John, and good morning, everyone. Can we have the first page, please? Thank you. So today we'll be talking about risks in your portfolio. And my goal for today's discussion is to give you a sense of how well your portfolio is positioned, or put it otherwise, is it working as intended? So over the next 20 minutes and 8 pages, I will try to analyze the current positioning of your portfolio and give you an intuition of how well it may perform in the future. So your portfolio is obviously, it's a mature portfolio of almost 80 billion that invests across majority of asset classes globally and relies on dozens of outside managers. It has a lot of moving parts and may be influenced by the markets, cash flows, rebalancing decisions, and choices taken by individual managers. So altogether, we classify these moving parts as risk. So risk means uncertainty, but it also means an opportunity to generate returns. What we want to assert today is whether your portfolio is taking risks consistent with its mandate. We'll try to answer 2 questions. First of all, is the current positioning of your portfolio stays within the bounds defined by the investment policy? So that's a question about today. And also, will the portfolio exhibit any unintended surprises as the market evolves forward? So this is the question about the future. As the first step, we need to define what risk means. It is actually not a simple question. Here we define risk in the way most natural to a large multi-asset portfolio. That is, we define risk in terms of the expected performance. Put it otherwise, we talk about risk in terms of the likelihood for the portfolio to generate the return, be it positive and negative. So in this context, we define risk as an expected return that we project to achieve over the next 12 months. We generally have 2 measures of performance, which is total return and active or excess return. So total return is generated mostly from the market exposure, and excess return is generated mostly by the skill of your managers. Both are important and give us different assessment of the portfolio. So much the same way, we define 2 measures of risk. Total risk is a measure of the expected total return, and active risk is a measure of the expected active returns. The key word here is expected, as our risk measure assumes about a 30% probability that the realized returns will be outside of our risk estimate, which can be either up or down. So you can see these 2 measures of risk in the table on your screen in the lower right corner. Total risk for your portfolio at the end of Q4 stood at 12.9%, and active risk at 2.3%. Just think about these numbers as the expected return for the portfolio that our model projects over the next 12 months. But what is the meaning of these numbers? Is it a source of concern, or should we take these numbers as a confirmation that everything is functioning as intended? Broadly speaking, the level of risk is determined by three main factors: by markets, by the portfolio construction process, and by the decisions taken by the managers. We'll try to break down the risk numbers along these three dimensions to make sense of them. The discussion today is very similar to what we presented in the previous few quarters, so I will move faster unless there will be any questions. We start with so-called market portfolio, which you can see on the left-hand side of the screen on the column 1. The main risk decision in the portfolio is the stock bond split. The decision is important because the returns and the risk profile, they're mostly determined by the equity levels. We represented by a simple 65-35 blend, 65% of MSCI all countries world, which is the broadest measure of equities, and 35% for Barclays US App. The portfolio construction section of the table on the top of column 1 shows you the main dimensions of risk for this portfolio, which is equity allocation of 65%, interest rate duration 2.2 years, and credit spread of 1.3 years. We have this market portfolio through our risk system bar 1, and you can see the results at the bottom of the table. So the total risk of this market portfolio is 12.6%, slight increase from the previous quarter. And here we introduce another measure of risk. So I keep mentioning that the risk is about the next 12 months. Here we focus on the most short-term measure, which is the beta to the S&P 500, which is just a measure of how much you expect your portfolio to move for 1% move in the S&P 500. So here you can see that the beta is 0.61, almost unchanged from the previous quarter. So let's keep these numbers in mind because this is the baseline. This is the starting point of our analysis. This is market. The next step in our analysis is to split the stock and bond allocation into further buckets, be it US equities, emerging markets, core fixed income, so forth. This decision is reflected in the policy benchmark, the strategic benchmark, which has 12 components, as shown at the bottom of the page. You will notice that the benchmark has small small differences from our market portfolio. The equity allocation is slightly down. The duration is also slightly shorter, but is broadly aligned with our market portfolio. What it means for risks, again, it's very similar. Slightly below, consistent with low equity allocation. But what's important that the magnitude, 12%, and the change, 0.1, is very similar to market. What it tells us is that the change and the level of risk in the policy benchmark is mostly determined by the markets. And finally, we're ready to move towards your portfolio, which is in column 3, labeled as NYCERS. And that's obviously where we allocate to individual managers. It includes all cash flows, all technicals, rebalancing decisions that we'll do in the portfolio. First of all, you can notice that the exposures of your portfolio is closely aligned with the benchmark, both on the equity sides, rates, and credit side. There are small changes. We'll go in more details on the next few pages. The portfolio risks are also closely aligned. The level of risk is slightly higher, 12.9 versus 12%. And this is, again, to jump a little bit forward, it's because of our private equity allocation. But broadly speaking, the risks and the changes for the quarter are similar and comparable to the benchmark. So what are the main takeaways from these numbers on this page? I actually think that this page is probably the most important in the presentation. It gives you like a one-stop summary, one-stop affirmation of your portfolio at the end of fourth quarter. So first of all, you can say that the risks in your portfolio are closely aligned with the benchmark as intended by the investment process. Why do I say that? Simply because the numbers are similar across the page. The second conclusion is that the expected performance of your portfolio and the risk exposures are mostly driven by the markets. And I know that because, again, your portfolio numbers, portfolio risks are closely aligned with the market portfolio. And finally, I want to draw your attention to the charts on the upper right corner of the page. So here we show the historical evolution of these three measures over the past 12 months. Chart 1 shows the evolution of total risk across these three portfolios we just discussed. You can see that the relationship has been steady. There were no significant changes, and yet another affirmation that everything is working as intended. You can see that the risk level were increasing throughout most of the year. It peaked around January and started coming down. I'm sorry, peaked around October. It started coming down by the end of the year. It's probably safe to say that given the current volatility, we expect to see these risk levels bumping up in our next discussion. And finally, active risk, which is a measure of excess returns. At the bottom of the page, again, the same picture. You can see the risk levels broadly steady, but increasing with market volatility, coming down slightly by the end of the year as market fall normalized. And again, we expect it to pick up for the first quarter of this year. So this was like a high-level view from a high vantage point across the portfolio. But let's see what it means in more details. So can we have the next page, please? So we've established that the total risk for your portfolio is 12.9% and active risk is 2.3%. Our next stop is to look under the hood of the components of this risk as shown on this page. Why is it important? We need to understand the components of risk to gain a better intuition of the sources of performance. It will also help us to understand where the losses may come from. And this information is particularly important to us given the forthcoming asset allocation exercise that the system is doing later this year. Let's take a look at chart 1 on the left-hand side of the screen, which shows the components of total risk over the last 12 months. As a reminder, total risk provides an assessment of the future expected total return for your portfolio. As you know, your portfolio allocates 65% of assets to equities and 35% to fixed income. But the components of risk look very different from this allocation. Maybe surprising, but the risks of the portfolio is almost entirely about equity. Fixed income is just the narrow orange band at the top of the chart and contributes only 6% of the risk exposures, despite having a 30% public allocation. The green band of public equity completely dominates the chart. Your portfolio allocates 44% to public equity, yet it contributes more than 60% to risk. Even more interesting is the blue band of private equity. It is a 10% allocation, yet private equity contributes 17% of risk, almost twice its weight. I think it's an important takeaway from this chart. So the risks of your portfolio are primarily equity, and in particular private equity, as one of its main risk contributors. Intuitively, it makes a lot of sense, as we saw this quarter and actually throughout the year, that private equity allocation delivered outsized returns. And as we know, outsized returns can work in both directions. I think it's an important message of this chart. Another message from this chart is that the risk contributions of equity and fixed income are additive, meaning both of them provide positive contribution. This is a direct result of how markets evolve during this current high inflation regime. The cornerstone of the asset allocation framework is the negative correlation between stocks and bonds, meaning that the bonds tend to rally during the periods of equity sell-off. This relationship held steady from around 1990s. However, you can see on this chart that it's no longer true, and fixed income allocation increases the total risk level instead of reducing it. It is reasonable to expect that this relationship was reversed as inflation is coming down, but for the time being, it's something we're keeping in focus. Next, we'll look at, on the right-hand side, chart 2. Here, we'll consider the components of active risk, which is a measure of the expected future excess returns. As you recall from the previous page, the active risk for your portfolio is running at 2.3%, meaning you can expect a 2.3% excess return from this over the strategic benchmark. But what are the sources of this expected extra return? As chart 2 clearly indicates, it's all about private assets. In particular, the private equity allocation contributes almost 80% of active risk. The public equity markets has a negligible contribution, but public fixed income is a diversified, meaning it detracts, with a negative 21% contribution. A large contribution to private equity can be partly explained by the fact that it's benchmarked to the Russell 3000, which is more of a performance measure rather than a risk benchmark. But I think it's important conclusion from this chart that the active risks, and meaning excess returns, it's all about private equity. So let's dive a little more into the portfolio. Can we have the next page, please? So as we continue looking into the components, we look at the breakdown of your portfolio along the dimensions of the strategic benchmark. So first starting with chart 1 at the top of the page. So here we see the breakdown of your portfolio across the main dimensions: public equity, public fixed income, alternatives, and cash. Here the blue bars represent portfolio allocations, and the orange bars represent the overweights and underweights. First thing you notice that the orange is almost completely missing from this chart, and that's obviously by design, as the portfolio is matched very closely to the benchmark. There's clearly a cash overweight because cash is not part of the benchmark. So that's as expected. And finally, at the bottom of this page, we'll look at the allocation for individual asset classes. And again, the conclusion is the same. You see that portfolio is managed very close to the benchmark. You see some deviations on the right-hand side of the page on the alternatives. Specifically, private equity has us overweight about 2.5%, and infrastructure is underweight. Again, I hope I'm not breaking any news here. It's probably consistent with what we talked about the previous quarter. Can we have the next page, please? Thank you. So here we look at the risks in a little more details. Again, we established that the market value allocation will not necessarily translate to the same risk levels. And we talked before how equities are predominant contributors to the risks in the portfolio. Here we look at the risks mapped along the strategic benchmark, and two things stand out. First of all, and I'm sorry, you can see that the blue bar represents allocation, market value, and the orange bar represents risk contributions. So first of all, there are two categories that punch well above their weight, meaning US equities and private equity. And yet private equity is predominantly domestic. You can see here that not just equity, but specifically US equity is one of the largest contributors to the risks. Fixed income, which meant to be balanced, provides very little contribution. You can see it on the core fixed income tips and high yield. Normally, would expect fixed income to be a detractor to stabilize the risk exposures, but because of the positive stock-bond correlations we just discussed, we do not see this effect. So everything is expected, no surprises. The main takeaway from this chart is the US equities. Can we have the next page, please? So next we'll look at the risks at the individual asset classes. And I keep saying that the risk and performance is very similar. So risk is just the expected performance over the next 12 months. So how do risk and performance align? Let's start with the absolute returns and absolute total risk, which you see in the column 1. Let's start at the top. The risk level for your system is 12.9%. You can see that it connects very nicely with the total one-year return of 11.6%. Unfortunately, it was a loss. In the public markets, for public equity, our risk forecast lined up very nicely with the one-year realized returns. So it's a check. On the fixed income side, the picture is quite different. So you can see that the risk levels are generally about 5-6%, but the returns, negative returns, are much higher. And that's simply, if you recall, I keep mentioning that there's about a 70% probability that we stay within our risk forecasts. That is actually one of these cases when we fall outside. And it's simply because of historically unusual fixed income markets. I'll go back to Steve's presentation just a few minutes ago. We need to go back to the global financial crisis and potentially back to the 18th century to find markets similar to what we experience now in the fixed income world. So it's not surprising that the returns exceeded our forecast. And finally, on the alternatives, obviously stellar performance across all asset classes. Broadly speaking, the returns were consistent with the forecasts. Probably the one standout I want to point out is private real estate, where the returns exceeded our risk forecast by a wide margin. So just another indication of how unusual this 1 year returns have been. It's probably not unreasonable to expect a reversion to mean. And next, we'll consider the relative returns, which is column 1. We're looking at active risk versus 1 year excess returns versus strategic benchmark. Again, starting from the top, you can see that the system performed exactly as intended. We project a 2.3% active risk against 1.8% excess return. It's a check. In the public market, starting with public equity, just as we discussed, active risk is low. You see about 1% active risk public equity, most of it coming from developed market ex-US, where we take exposure to more activist managers. And that's actually where we see significant excess return, right? Where we exceeded our forecast by a wide margin. We forecast 2.8 versus the realized return of minus 5.6, which again, not surprising given the strategy and the current markets. On the public fixed income side, I would say everything is consistent. Convertibles being a notable outlier, but it's more of a hybrid asset class with strong equity exposure. But across core fixed income tips, and I would say almost high yield, the risk levels and the returns are consistent. I don't really focus that much on alternatives access returns, where the benchmark are probably more of a performance measure rather than risks. The important message of this page is, first of all, that our risk models function as intended. They provide a meaningful and reasonable capture of the risks in your portfolio. And the returns, which is a backward-looking measure, are consistent with our forward-looking assessment. So I take this page as another confirmation that your portfolio is functioning as intended. So this is a discussion about the past. It's a discussion about your portfolio as it evolved over last year. And we can broadly make a statement that it's positioned as consistent with the policy. What about the future? So can we have the next page, please? So in the next stage, we'll try to assess how your portfolio will perform in the future environment. Will it perform consistent with the investment policy? So first of all, we need to define the dimension of risk. And here we split the world into 3 broad buckets. We define the equity factors, rates, and commodities. And commodities here really stand for the real economy. These are the main risks that affect your portfolio and may determine its performance. On the equity side, we'll focus on the domestic equities, the S&P 500, emerging markets, and the European stocks. So altogether, these 3 indices make about 70% of the global equity capitalization. On the rate side, probably the most important rate is the 2-year Treasury, and it's really a proxy for the Fed fund rates. And it also includes the market expectations for the future policy action for the Federal Reserve. The 10-year Treasury is probably one of the most important rates globally for the real economy. That's what determines mortgage rates, corporate borrowing, not just domestically, but globally. And finally, the euro-dollar exchange rate. It's a proxy for the US dollar. As we all know, the dollar has a very special place in the global economy, being the world reserve currency. On the commodity side, we picked three measures. First of all, copper. Copper is one of the most important inputs in pretty much everything being manufactured. So we think of copper as a proxy for the global GDP, global economy. Oil is everything, right? Oil is transportation, it's manufacturing, it's heating, it's power. And finally, inflation, which is obviously something that we're concerned for the past 2 years. So once we determined these market factors, we established the market shocks. So we don't know what the future will bring, but what we can do is we can ask our risk system, what is the expected, what is the most severe market shock we can expect over the next 12 months? We do not forecast the future. We simply make our conclusions from the current market environment. You can see the shocks on the table on the screen. Here we compare also Q4 with the previous results. So I just want to pause for a second here to appreciate the magnitude of these shocks. These are truly big numbers. For equities, we expect a material probability that there will be a monthly almost 30% return over the next 12 months. These are big moves. On the rate side, the moves are equally enormous. We project the 2-year treasury to have a 140 basis point move. You may think these are big, unthinkable numbers, but actually the 2-year treasury just had a 120 basis point move over the past 3 days. So it's actually interesting to see that our risk forecast, which we actually done before the current banking crisis, are very consistent with the current market environment. Similar project an almost 11% move for the dollar. It's a big move, but not unthinkable. Same for commodities. Like if you look at our forecast of oil, almost a 60% move, it's big, but keep in mind within the last 2 years, oil moved from being negatively priced to price 120 and to the current level about $60 to $70. So they're big moves, but not unthinkable. So what does it mean for your portfolio? Can we have the next page, please? Thank you. So here we capture the results of how your portfolio will perform under these market scenarios. We split results into 2 categories: the risk on, color-coded green, which represents a rally in the markets, and the risk off, colored red, representing the sell-off. So altogether, we'll show you 18 possible outcomes for your portfolio and 18 outcomes for the benchmark. So it's 36 stress tests altogether. I'm not going to read the numbers of the screen, instead focusing on the main takeaways with the goal of identifying the factors that have an outsized impact on your portfolio. Let's start with equities, lines 1 through 3 in the table. We're focusing on risk on, which is on the left-hand side, but the results are probably the same for the risk off. As you can see that among 3 markets, the US equities have by far the largest impact on your portfolio. I find this to be a positive result. At the same time, the growing exposure, more significance, is the Euro stocks. Currently at almost 16%, but used to be 14% in the previous quarter. So whatever's happening in Europe is becoming more important and may have more influence on the outcome of your portfolio. Exposure to the emerging markets, and that of course means China as well, declined slightly. It used to be 14.2% the previous quarter. Now it's 13.9%. So again, it's not necessarily a bad thing. Next, we're focusing on the rates bucket. And that's why I find the results to be most interesting. So first of all, the first conclusion is that your portfolio is actually not that sensitive to the Fed fund policy. For a 140 basis point decline in the 2-year rates, our model project about a 1.3% increase in the portfolio. It is still a relatively small number, but notice that the previous quarter, the result was only 0.5%. So it's a significant increase and something we're watching. The move is much larger for the 10-year, close to 2.6%. Again, not that significant, but it's a material increase from the previous quarter when the outcome was 1.4%. But look at the move for the dollar, for the USD exchange rate. Clearly, the US dollar has an outside impact on the performance. A decline in the exchange rate of 10% will increase the value of your portfolio by 6.9%, which is similar to the previous quarter. So I think it's an interesting outcome. So as we read the news and focus on different parts of what's happening in the markets and economy, obviously the Federal Reserve and the Fed fund policies in the news, it's very important. But it's actually the dollar that you need to watch to understand the outcome of your portfolio. And finally, the commodities bucket. This quarter, the sensitivity to copper, which is the GDP proxy, increased slightly from 7.1% to 7.4%. This category now dominates the commodities. Oil prices are not that significant to the portfolio. I think it's a positive outcome. Actually, the impact of oil prices declined slightly for this quarter. It used to be 6%, and now it's 5.3%. And the same can be said about the exposure to inflation. It actually declined from 7.4% to 6.6%. Maybe counterintuitive, but the portfolio returns are positive in the environment of rising inflation. And I could say the same about exposure to commodities. So let me summarize the main takeaways from the forward-looking projections. First of all, the main macroeconomic factors that impact your portfolios are the domestic equities. The portfolio has a lower sensitivity to the European and Chinese stock markets. The strength of the US dollar exchange rate. Weakening of the dollar will have a beneficial impact on the performance. And finally, inflation and the GDP expansion. The rise in nominal inflation will lead to positive returns. High inflation GDP growth point in the same direction, expansion of the nominal GDP. I find this framework helpful to understand the main risk of your portfolio and to connect the performance with the headline news. So what are the main takeaways from this forward-looking stress testing exercise? So first of all, it confirms that the performance of your portfolio under the extreme conditions is projected to be consistent with expectations. A second conclusion is your portfolio is positioned at slightly higher risk level versus the benchmark, primarily due to the private equity allocation. How do I know this? You can simply see it across the excess returns. They are positive in the risk on and negative in the risk off. And finally, the last conclusion is that the portfolio has little downside protection on the scenarios tested, meaning that the returns, excess returns, are almost the mirror image on the risk on, the risk off scenario. Only the S&P and 10-year treasury scenarios exhibit small amount of downside protection. And finally, let's take one last stop to understand the portfolio. Can we have the next page? Much like before, we take a look at the breakdown at the individual asset classes. So here, focusing on the three most important scenarios, and we show the performance of individual asset classes as determined by the strategic benchmark. So I'll just highlight the main conclusions from this page without reading all the numbers. So first of all, it's not surprising that we get more action from the equity round. So you can see that just the size of the bars is much higher in the chart one, where we look at the S&P stress test. The USD and the inflation scenarios, chart 2 and chart 3, provide more contribution from the non-equity asset classes, meaning that the gains are more evenly distributed, which is exactly the purpose of the multi-asset portfolio. The next conclusion is, again, we see little risk diversification in the portfolio across the asset classes, meaning that in almost all scenarios, all the bars are pointing in the same direction. Core fixed income doesn't really have any material impact on performance under either stress test. There's a small detraction on the inflation, but in the current environment with the positive stock bond correlation, core fixed income does not provide the diversification as we expected over the long run. And the last point I want to make is that the portfolio outperforms the benchmark under every single stress test. This is true for the risk-on scenario, where that performance is desirable, but unfortunately also true for the risk-off scenario, where the portfolio performs slightly worse than the benchmark, which again is consistent with every observation we made in the first 2 pages. So just to summarize at the very end, so we established that your portfolio is performing consistent to its policy in the current environment. And we can also assert that for the future projections, we see that the portfolio performing consistent. So I'll stop there and open to any questions.
So if there's no other questions, and again, I'll remind everybody that both Ed and Steve are available in case trustees have questions. So with that, I believe that has concluded the public agenda, and we'll entertain a motion.
John?
Yes.
I'd like to reflect for the record that Karina Lazada and Keisha Sutton James have joined the meeting as NYCERS trustees.
Fantastic, welcome. So with that, we've concluded the agenda for the public session, and we'll entertain a motion to enter into executive session.
So moved.
Thank you. Is there a second?
Second, Ruben Torres.
Thank you. So all those in favor, please indicate by saying aye.
Aye.
Any opposed? Any abstentions? Hearing none, the motion carries. We'll be going into executive session. So if we could turn the cameras off, and we will invite our colleagues from the Board of Ed to stay for the duration. Okay, we are now in public session. Melanie, the report out, please.
The board agreed to commit funds to 2 private equity and 1 real estate investment. The details of these transactions will be released at a later date.
Thank you, and I'll make a motion to adjourn.
Second.
Thank you, Mr. Katzman. So, and nobody, a chorus of ayes, it looks like. So thank you, everybody, and have a wonderful day. We stand adjourned.
Thank you. Thank you.
Thank you all.
Thank you, Ben.